Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, March 6, 2009. It's 11:30 a.m. Eastern Standard Time in the U.S., 4:30 p.m. in London, it's 12:30 p.m. in Bermuda, and 9:30 a.m. in Mexico City. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. A bit of housekeeping. In the United States, the country will switch to daylight saving time this weekend. This means we will spring ahead 1 hour. Our broadcast will continue on Monday at 11:30 a.m. Eastern Daylight Time. However, Great Britain will remain on Standard Time, and the show will be being broadcast in London at 3:30 p.m. on Monday, and will remain at the 3:30 time until you switch to British Summer Time. We will investigate how this affects Bermuda and Mexico City and post a notice on our board. But at least for the foreseeable future, until the British go to summertime, you'll be watching the show an hour ahead of time. One bit of news before we start. Just before we came on, we saw that General Motors is trading at $1.44 a share. This is the lowest price. Face price, not even including inflation. This is the lowest trading face price GM has been trading at since the year 1933. It's very depressing news. Now to our main news, and this is maybe part of the reason why the price is as it is. The stock market's down about 33 points now. It's a miracle it's down that little after yesterday. The American unemployment numbers came out, and they popped up to 8.1% during the month of February. This is the highest rate since 1983. During February, employers cut another 651,000 jobs. The number is worse than what analysts expected. The net loss of 651,000 jobs in February came after even deeper payroll cuts in the prior 2 months. The economy lost 681,000 jobs in December and 655,000 in January. February was only 651,000. There was a minor rally on the stock market when it opened at 9:30 as people were optimistic. The breakout of the job losses is as follows. Construction companies eliminated 104,000 jobs. Factories eliminated 168,000. Retailers cut about 40,000. Professional and business services got rid of 180,000, with 78,000 jobs lost at temporary help agencies. Financial companies reduced payrolls by 44,000. Leisure and hospitality firms cut 33,000. The following areas were spared: education, health services, and government, all of which boosted employment last month. Eric Dinello, the superintendent of insurance of New York State, has been generally getting extraordinarily good press and walking from one lily pad to another despite being surrounded by a number of infernos in New York. Yesterday he received a little bit of a different reception in front of the Senate Banking Committee down in Washington. He was met with criticism from the leadership of the committee as Dinello tried to defend state regulators' role in overseeing the AIG situation. Dinello fell under the microscope as lawmakers sought to determine why the government continues to have to prop up the company up to $170 billion now, and they were seeking answers as to how much more is going to be needed. In his opening statement, Senator Christopher Dodd, the chairman of the committee from Connecticut, said the debacle at AIG is quite frankly sickening. He said the lack of transparency and accountability in this process has been rather stunning. The strongest comment came from Senator Jim Bunning, who is a former Major League Baseball player. He's a Republican from Kentucky. He called AIG a lost cause. He ridiculed the regulators, especially the Treasury Department and the Federal Reserve Board, for not knowing exactly how much it's going to cost to stabilize the company. Dinello was criticized mainly because of AIG's securities lending program, a program that resulted in a $21 billion loss by the firm's life insurance subsidiaries. The Federal Reserve created a mechanism back in December that took AIG off the hook for the securities lending program. Dinello, however, was steadfast in defending state regulation. In his testimony, he said AIG's problems did not stem from its state-regulated insurance companies. He said the primary source of the AIG problem was its financial product sector. which had written credit default swaps, derivatives, and futures with a notional amount of $2.7 trillion, including about $440 billion of credit default swaps. He contended that the main reason why the federal government decided to rescue AIG was not because of insurance companies, but because the problems caused systemic risk coming out of AIG's financial products unit based in London. He did say that the systemic risk that was caused by the securities products that were sold by the London office that were based on the AIG credit rating, that is in fact based on the life insurance and insurance background and credit rating of the company, should have been monitored more closely. Senator Richard Shelby, the ranking minority member, criticized Dinello's defense of state regulators by saying your testimony is ambiguous. According to the National Association of Insurance Commissioners, a life insurance company may participate in securities lending only after it obtains the approval of its state insurance regulator. If so, Senator Shelby continued, why did state securities regulators allow AIG to invest such a high percentage of collateral from its securities lending program into longer-term mortgage-backed securities lending, since it involved life insurers regulated by at least 5 states? Some more AIG news came out later in the day, again from Superintendent Dinello. This is a story that's long been suspected in the insurance industry. We've been hearing it too. AIG has been the subject of complaints from rival insurance companies who say that AIG is underpricing commercial coverage. Competitors say that AIG has been able to charge lower rates after getting the government help. Eric Dinello articulated this complaint in an interview with Bloomberg Television yesterday. He said, quote, "We worry just as much about low pricing as high pricing because the industry needs to have enough money to pay claims that may emerge years after the policies are sold." According to David Sampson, head of the Property Casualties Insurers Association of America, government help, quote, allows unhealthy insurers to grab more market share in the short term at levels that are unsustainable in the long term. AIG, of course, said that they're not cutting rates below sustainable levels. They said we're not sacrificing underwriting integrity to retain market share. We believe that allegations of excessive price cutting by AIG are competitively driven and are coming from our competitors frustrated by their inability to win significant market share from us. Ed Kelly, Liberty Mutual's CEO, said in a conference call in November that AIG is doing some very stupid things by cutting rates to win business. Meanwhile, yesterday in a speech in Hong Kong, AIG CEO Edward Liddy said AIG is committed to maintaining the underwriting discipline that has always been essential to our success. It will do us no good to overcome today's financial problems only to find a few years down the road that we're sitting on a pile of unprofitable insurance policies. From your lips to God's ears, Mr. Liddy. There's a story in the Insurance Day that's reporting on a story that's being run in the Parisian newspaper Le Figaro. This is coming from an interview with Claude Bébert, who is the former chairman and founder of AXA. According to Mr. Bébert, AXA does not need to raise any capital. He says that other companies have given in to pressure, but he thought that conducting a capital increase in the current market conditions needlessly impoverishes a company's own shareholders. He said that AXA's current management was being cautious in limiting the dividend payout, and by asking shareholders to authorize the issuance of preferred stock, quote, only if it proved to be absolutely necessary, which is not the case. AXA's share price has declined by more than 50% since the 1st of January, but Bébert said that AXA was strong and relied on good operational performance, positive cash flow, and operated in long-term growth markets. Bébert said that the AXA stock price had been affected by what he called gregarious behavior shown by investors and also by market players such as arbitrageurs and hedge fund managers who have deliberately sought to push down AXA stock. Mr. Bébert is a long-term critic of the short view taken by most investors. Now, here's some news coming from Allianz. One of the company's subsidiaries, Allianz Global Investors,